The sale of an asset has its own particular treatment. Imagine that we today are selling an asset that has gross value of 35. Depreciation is 10, and so a net value of 25. Assume we sell it for 22. Obviously, giving something that is worth 25 on our books for only 22 is not the best business outcome. So we record a loss of -3 on the income statement. Please note that any item on the income statement affects both the cash flow statement and the balance sheet. Just like a mustache. We have to send -3 to both left and the right. Now on the cash flow statement, the loss of -3 is not a cash loss, and it is not an operational loss. We did not lose 3 of cash. In fact, we made 22 of positive cash. And that cash goes on the cash flow statement from investments. Selling PP&E is an investing item. So the cash of +22 goes there. Now there was no cash movement in operations. We did not sell any pizzas. There is no operating cash. So the CFO is 0. To arrive to 0, the -3 in net income under the CFO has to have a +3 adjustment to bring the total to 0. This adjustment is just like depreciation adjustment for the cash flow statement. Both are non-cash items. Remember, we also have a -2 under retained earnings, equity is less, and we are poorer. Assume now that we will sell the same asset for 27. This time, we sell it at 2 more than its net book value. We have a gain on the income statement of +2. Again, any income statement transaction affects both the cash flow statement and the balance sheet. So we have the mustache again. 2 goes to retained earnings on the balance sheet, and 2 goes to the cash flow statement. We sold the PP&E for a gain, so we are richer. Another 2 goes on the CFO, but remember, CFO always has net income as a starting point. So there is +2 on the net income, then there is +2 on the CFO. But there is no operating cash. We did not sell any pizzas. This has to have a -2 adjustment. We call it adjustment to non-operating loss. And now the CFO is back to 0. Under the CFI, we record the cash received, and that is a +27. Remember, each time we hit the income statement, we need to make a mustache. Mustache, mustache, mustache. Never forget. Remember Salvador Dali, Charlie Chaplin, Einstein? When you think of these people, remember to put the mustache on the income statement. Now, how do asset sales help accounting manipulations? Well, they help plenty. You are a CEO that needs a bonus, desperately. You are getting married this year. What do? You do some accounting trick to boost your profits. So your bonuses are bigger. You have 10 assets. Some performing poorly, some are doing great. Which one should you sell as a good CEO? Well, if you're a good CEO, you should get rid of the underperforming assets. Is that what you would do? Nah. Selling underperforming assets leads to losses. Your bonuses will be cut even more. You probably will sell a good performing asset, record the gain, and collect your bonus. As a CEO, do you care that the company and shareholders will suffer in the long term? Perhaps you do not care about them as much as you care about your bonus. Plenty of asset sales in real life. IBM sold the full business, including its assets, a few years back. Kyndryl was a major IT business that produced Red Hat, if you remember, the popular Linux software. That part of operations was huge for IBM, 25% of their total business. How did the sale happen? They offered a spin-off, Kyndryl, to their own shareholders. So they gave them 80%, while IBM, the company, kept 20% of it. The cost of the spin-off were huge. They had to pay a lot of fees, part to guarantee the pensions of employees, part for taxes, and part to support existing clients. These fees were huge, $1 billion in 2021. Was this a good spin-off? not the best actually. If Kyndryl was such a great business, they would have sold it to another company at a profit. Here, they simply offer the shares to their shareholders. So if you held one share of IBM, you would not have shares in IBM and shares in Kyndryl. You owned one company, now you own two. Funnily enough, at separation, Kyndryl was valued at 40. Now it is worth only $15 a share. There you go, a disaster of a separation. The sad thing is that Goldman bought 10% of Kyndryl from IBM, not their greatest investment either. Your delivery truck worth a net of 25 gets into an accident. It is completely smashed. The driver was coming home after an all-night party in Ibiza, driving the company truck. How bad of the driver? Forget, it has happened. Done. The truck is now worth 0. Our net loss is 25. We are poorer. We got the truck no more. The first thing we do is put an impairment loss on the income statement, and then we immediately do the mustache. Now we have an impairment. That we lose cash? No, it was just a crash. We did not have to pay anything. So there is no cash outflow and the CFO has to be 0. We need to adjust again under the CFO. Plus 25 with the heading adjustment to non-cash loss and bring the CFO to 0. Equity has to be reduced by 25 because of the mustache, and the heading is under retained earnings. Asset impairments might be non-cash, but they matter very much. An impairment means that something that you previously paid a lot of money for now is worthless. You remember some years back, Range Rover wanted to make a mid-sized SUV, one that fits families and is softer. The Range Rover Evoque, do you remember? Many celebrities were involved in endorsing it. I will not mention them, as we do not want people to think that accountants are mean. How much did that impairment cost? $4 billion of an accounting adjustment. The reason is simple. They had spent billions building a new factory to produce the Evoque. No one is buying the car. The new factory is worthless. We have to bring assets values down. What happened to the stock price of the company? Lower by 18%, an amount that reflects the stock market's assessment of the damage done to the company. Impairments happen everywhere all the time. Just Eat, the leader in food delivery, purchased Grubhub, another delivery company, for $7 billion. 2 years later, they decided that Grubhub is not worth so much after all. All purchased at inflated prices in the COVID eat-at-home craze. Do we still eat at home like before? Nothing like before. Grubhub is not bringing the profits it used to. Time to write the assets down. For some reason, Just Eat thought that we humans will continue eating at home for the rest of our lives.